Yeah, you are audible, sir. Clear.
Thank you very much, Ramesh. Thanks a lot to you and your entire team for inviting me. And welcome, you guys. Thank you very much to all of you for joining today's session. And before I start, let me ask you a simple question. How many of you agree that true independence or true freedom in a life cannot be achieved without financial freedom? If you agree, then please type agree in the chat box. Guys, I would request all of you to please interact with me with the help of chat box. I am going to ask you a lot of questions, right? So please let me know your view whenever I ask you something. It will help us to make this session more interactive and more interesting. Right. So all of you agree, right? If you want to achieve a true freedom in your life, it cannot be achieved without the financial freedom. And let me ask you another question. How many of you would like to become financially free as soon as possible? If your answer is yes, please type I in the chat box. Please type I in the chat box if you would like to become financially free very soon in your life. Thank you very much. Thank you very much, guys. Then, guys, you guys are at the right place at the right time. I'm Jigar Parekh. I welcome you all today for this session called How to Achieve Financial Freedom Through Your Investments. So, guys, we are going to talk a lot about financial freedom. What is financial freedom? What is the meaning of financial freedom? How to achieve it through investments, right? Equity, mutual funds, and there are some risks also which are involved into the process of achieving financial freedom. What are those risks? How to overcome risk? And finally, last but not the least, we are also going to talk about, because when we talk about investment, when we talk about mutual fund, when we talk about equity, I'm sure all of you might be having one question in your mind. Market is as almost all time high. What next? From here, where can market move? Right. So that is something which you are going to discuss today next 1 hour of time. So once again, before I start, let me give you a big thank you to all of you. I know it's a Saturday, uh, weekend, Saturday, Sunday, you can enjoy with your family. Instead, you have decided to join here with us to learn something. And I guarantee you, the word is guarantee. I give you the guarantee that next the next 60 to 70 minutes of your time, which you invest with us, you'll definitely get a wonderful value out of your investment of time. So with that note, let me once again ask you, if you guys are ready, please type ready in the chat box so we can begin. Please type ready if you guys are ready. I've given you the agenda. What is the agenda? I've shared the brief about the agenda. If you guys are ready, please type ready in the chat box. Thank you very much, guys. So, why, guys, before I start talking about the independence, right, currently we are in a month of August. And when we talk about August, like August is also a month of freedom. On 15th August 1947, we got our precious independence. And there was a big war, or maybe big fight which was behind achieving this freedom, which started, the independence war started in 1857. 1857 was the starting of kind of a revolution where uh, a lot of people in India started their muhim towards achieving the independence from the English rule. Now this movement started in 1857, but, and I'm sure all of you would agree with me, a lot of people, lakhs of people have given or maybe sacrificed their entire life uh, in achieving this precious financial freedom, and we must thank them. Because I personally believe life with you, like no matter how much money you have, but life without a freedom is nothing. Life without independence is not a life at all, according to me. So a lot of people, lakhs of people have sacrificed their lives. Some of them we know their names, and there are plenty of people, there are numerous people whose names are also not known to us, but they have sacrificed their lives for us, for giving us the freedom so that we can enjoy the freedom. So we are in a month of August, and I would like to salute all those martyrs, all those people, all those freedom fighters who have fought this precious war. Uh, and because of their effort, we got the financial independence in 1947. But as far as the freedom fight was concerned, there are a lot of movements which are happening, but this Agast Kranti movement is considered to be the final movement, final nail on the coffin as far as the freedom fight was concerned. It started in 9th August in 1942 when Mahatma Gandhiji gave the Nara of quit India, and that was the last and the biggest movement, right, which is also considered to be the one of the biggest movement and the reason for independence. So I would like to remember all those martyrs, all those freedom fighters who have given their life, they've sacrificed their family, life, money, everything. Right. So please type salute in remembrance of all those freedom fighter in the chat box. Please type salute. Please type salute in the chat box, guys. Right. And again, uh, achieving freedom is one thing, and maintaining freedom is another thing. So as far as achieving freedom is, definitely it's very 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 important, but maintaining the freedom is also very 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 important, and it is our responsibility, right? And all the three wings of our army, navy, and air force, a lot of people have joined our three wings of army, like whether it is a Indian army or maybe naval forces or maybe air forces, and a lot of people are still sacrificing their current life, and they're doing a lot of efforts to protect our boundaries and to ensure that we can enjoy our financial freedom, not just financial freedom, overall independence, right? So let's type salute to these people also, the entire three wings of army, navy, and air force. So from my side, I would like to thank them, acknowledge their contribution in helping us to maintain the financial freedom. And as I told you guys, as I told you, freedom is nothing without financial freedom. If you are free, if you are independent, but if you are not financially free, then you will not be able to enjoy the independence. And we have seen the not just families, not just individual person. We have seen countries like, just like Sri Lanka. Before a couple of years, we have seen the kind of a their internal war they had. It's a kind of a civil war which they had, which was a big worry for them, because of the they didn't achieve the financial freedom. Financially, they were not sound. Financially, on the bankruptcy, and because of that, there were a lot of social unrest in the entire country. So in our life, we need to learn one thing, that we need to ensure that if we want to achieve the, or if we want to enjoy the freedom, we need to achieve the financial freedom. Now financial freedom is different from the freedom. I am free, I could be free, we all are free, like we 140 crore Indians are free, definitely free. We are not having any other country ruling us. But financial freedom is different from freedom, and it is very 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 essential to achieve in our life. Now what is financial freedom? Now definition for financial freedom would be different for everybody. For somebody it would be earning a lot of money, for somebody it is having a zero debt, for somebody the definition of financial freedom could be being able to afford lavish vacation every year, for somebody it would be buying a bigger bungalow, for somebody it would be buying a bigger car. So definition of financial freedom would be different for everybody, but my definition is very simple, and the most logical definition which all of you will be able to relate to. And that definition is simple, that you are financially free when you are working because you want to, not because you have to. Let me repeat, you are working because you want to, not because you have to. That is what financial freedom for me. So for example, currently I am 42 years of age, but at the age of 34 I became financially free. It doesn't mean that I got retired from my profession, from my job, or from my business. I'm still continuing my economic activities, my professional activities, but right now I'm doing it because I want to, I love it. It is not because that I have a compulsion. And you will get, once you reach this situation where you can, you're not, your entire day or maybe your entire calendar is not based on the money, right? Money is not deciding, income is not deciding your calendar. You're the own person, you are deciding your own calendar. And tomorrow also, if you want to retire, you can retire. If you achieve that financial status, then you can say you are financially free. And to simplify this formula in even better manner, let me give you the definition, and I would request everyone to write down this definition. Not definition, rather let's call it a formula. This is the formula to achieve financial freedom. When in your life your passive income is more than your expenses. So say for example, if your monthly expense is 50,000 rupees and you're already earning, every month you're earning more than 50,000 rupees of income, and that to a passive income, then you are financially free. It doesn't matter. See, active income has nothing to do with the financial freedom. So say for example, your salary is 1 lakh rupees and your monthly expenses are 50,000 rupees. So your income is much more than your requirement, but you're not financially free. Why? Because to earn that 1 lakh rupees, you'll have to go to your office from 10 to 8. Right? But passive income means what? Passive income is very simple. Once you build something, whether it is a business or investment portfolio, once you build it in such a way that it starts giving you income, even if you are not actively working. So there are two types of income: active income and passive income. Active income requires you in the equation, requires you to work 8 to 10 hours a day. Then only it will come. Then it's active income. No matter how big your active income is, you're not financially free. You're financially free only when your passive income is more than your expenses. If you understand this concept of passive income, then please type passive in the chat box. Right? If you understand the difference between active income and passive income, I'll give you some examples also. Right? So say for example, if I have a property, and if I rent it to somebody, I'm getting a rental income. That rental income which I'm receiving is a passive income. To receive that rental income every month, I am not supposed to go to any office or any factory from morning 10 to evening 8. It is going to come because I have built the asset, and that asset is giving me some money. That is a passive income. All right. So I'm sure there is a very famous book, uh, which uh, has made this concept of passive income very popular. The name of the book is Rich Dad Poor Dad, and the author is Robert Kiyosaki. Now, he has divided the type of income or type of professions into four different quadrants. You could be, if you're a profession, if you're earning something from some activity, then you will fall into one out of this four, or maybe more than one out of these four boxes. There's the four types of income generation, generating activities. E means employee. So if your income is coming from the salary, right, you are into E segment. And if you're into E segment, you are not financially free because your income is purely based on time you devote to your job. Then S means self-employed. You're not employee, but you're working for money. Say, for example, chartered accountant who is working for fees. He's not employee of anybody, but he's not even businessman also. He's just self-employed because to earn the money, he or she will have to work 8 to 10 hours of a day. So E and S, their main source of active income, right? While B and I, their major source of passive income. B means business owner. So if you have built some business which is running without you, so you have a team in place, you have processes in place, and even if you don't go to office or factory, it keeps on running without you, then whatever income you are generating from that business is a passive income. And second way of earning the passive income is I. I means investing. You invest into somebody, say something. Say for example, you have a fixed deposit and you're earning interest. Interest is passive income. You have some flat real estate. You're giving that real estate for a rent. Rental is a passive income. You're buying some shares. You are getting dividend. That's a passive income. You're investing into mutual funds. You're withdrawing from systematically from mutual fund through SWP. That's a passive income. So if you want to become financially free, you will have to create a source of passive income. Right? That is possible only either with B or with I. Now, B is not the cup of tea of everybody. B is not the cup of tea of everybody. Like business requires a lot of other efforts also, risk taking ability also, a big capital also. But I is something like being investor is something which can be done by anybody to achieve the financial freedom. If you're employee, if you're self-employed, if you're a business owner, you're earning some money, you can save some money, you can invest it and build some portfolio which gives you the passive income. I is possible for everybody. Even if you're falling into the E or S quadrant, you can become financially free with the help of I. And today we are going to talk about how to become financially free with the help of being investor by remaining in the I quadrant, right? So let me just summarize whatever theory we have discussed till now before we go get into the practicalities of financial freedom. There are only two types of income, two types of quadrants which can give you passive income. One is business, another is investment. And let me tell you, all businessmen are not financially free. If your business requires you to be present at office or at home or at factory or at shop, and without you, if your business is not running, then you're just self-employed. Your income is still not active income. Got it? So whatever we are going to discuss in next 50 to 55 minutes is how to achieve this financial freedom with the help of investment. The answer is very simple. You'll have to build an asset which can give you the passive income. Right? So you're earning, say for example, 100 rupees. You're spending some money, you're saving some money. So whatever money you save, you invest it in such a way that you get a better return and you create a very good portfolio which is more than enough to give you the passive income which is more than your expenses. So as far as theoretical aspects of financial independence was concerned, I think we have completed the theoretical aspect, and now we are going to practicalities of how to achieve financial freedom through investment. But if you understood the theoretical concept of passive income, then please type U in the chat box. U means understood. U means understood. Please type U in the chat box if you understood the concept of passive income and its relation to becoming financially free. Right. So let's move on. Now, if you want to invest, you have various options. You have one, equity market, share market. You have gold. You have fixed deposit. Right. Majorly equity, gold, fixed deposit, and property. These are the normal areas where you invest major chunk of your money. Now, if you compare the returns from this various investment classes like equity from 1979 to 2023, it has generated the return of 15.72% every year compounded. So Sensex started in 1979 with 100 point. Today it is 66,000 approximately, or maybe 65,000. So if you find out the rate of return, it is approximately 15.72%. While on the other hand, gold has given you the return of 9.98%, starting from 1979, from the birth of Sensex till today. And fixed deposit, the average return from fixed deposit from 1979 till 2023 has been 7.7%. Now, understand one thing. There is a difference between saving and investment. Now, what's the difference between saving and investment? By the way, tell me, how many of you agree that there is a difference between saving and investment? If you agree, please type agree in the chat box. If you agree that there is a difference between saving and investment, then please type agree in the chat box. There is a big difference. What is the difference? The difference is that saving just safeguards your money and investment helps you to grow your money. So anything which protects your money from inflation is just a saving. Now, what is inflation? Right. By the way, how many of you have heard the name of Warren Buffett? If you heard the name of Warren Buffett, please type WB in the chat box. Please type WB in the chat box. Warren Buffett is one of the biggest, or maybe the most successful investor in entire world, right? He has given these two golden rules which nobody should forget. He said every investor should remember these two rules, and they are very crucial rules. Rule number one, never, ever, ever, never lose the money. Rule number two, never forget the rule number one. Now, why did Warren Buffett say that never lose the money and never forget rule number one? Because I personally believe when you invest your money, when you convert your saving into investment, the first thing which is the foremost importance is safety. Safety comes first. While taking any investment decision, you should consider whether your investment is safe or not. Safety is the primary concern which every investor should keep in mind. If you agree, then please type safety in the chat box. Like you, I'm sure you expect a lot of things from your investment. You expect that it should give you liquidity, it should give you better return, it should give you monthly income, it should give you capital appreciation, it should be safe. But out of all these criteria, I think safety is the most important. If you agree, then please type safety in the chat box. Thank you very much. Now, what is the definition of safety? Most of people have a wrong definition of safety in their mind. Let me give you an example. If you have 100 rupees of note and if you put it in a locker, you lock the locker for 10 years. Now, after 10 years, when you open the locker, that 100 rupees note is safe. But what about the value of that 100 rupees? After 10 years, will it increase or will it decrease? Tell me through chat box. Will it increase or will it decrease? I or D? Let me know through chat box. I or D? I means increase, D means decrease. Decrease. Why it would decrease? Because of something called inflation, right? Because of something called inflation, long-term inflation, starting from 1979. If you take the data of inflation, historical average inflation has been 7.59%. So safety doesn't mean that your money should remain safe. Safety means your money's worth also should be safe. So 100 rupees today is not equal to 100 rupees after 10 years. After 10 years, the value of that 100 rupees will go down. Even if your 100 rupees note is intact, you have lost. You have lost a big value because of the inflation. So write down this rule. When it comes to personal finance, investment, building portfolio, achieving financial freedom, the first rule is whenever you invest, always look for the positive real rate of return. Now, what is positive real rate of return? Say, for example, if you're earning 8% FD from FD, and inflation is 7%, then your real rate of return is only 1%. If your inflation is 7%, your FD is giving you 7%, you are neither earning anything, you are nor losing anything. You are just maintaining your financial status. You're not becoming richer, you're not becoming poorer. If it makes sense, please type sense in the chat box. Right. And a lot of people say that for me, the safety is paramount. According to, like, for me also, safety comes first. Whenever I invest my money, I also look at the safety. I also give the safety the most, consider safety as a most important criteria. Right. But when it comes to safety, you should not only worry about the market risk, because safety means we need to safeguard our money from the risk. So there are two types of risk. One is market risk, which we all know. When you invest your money and if market goes down and your portfolio value goes down, it's called market risk. But very few people look at the inflation as a risk, because inflation is invisible risk. Inflation is invisible risk, but it is much bigger risk than the market risk. 100 rupees kept in a locker in 1979, today's value is only 3 rupees. It has lost 93% of value. So whenever you invest, you need to earn better than inflation. Then only your portfolio will grow. Then only you will be able to create an asset which can give you passive income to become financially free. Historical FD rate, if you look at historical FD rate, since 1999, I've got the data from the various sources like RBI website and various publications of RBI, and I could find out that the average FD return since 1999, from where the data is available, it is 7.7% average. So if you look at the FD return, it is hardly giving you any protection against inflation. So it is not investment. FD is not investment. It could be saving. Yeah, it could be saving, but it is not investment. And to become financially free, you will have to invest and create the wealth and create the asset. Saving cannot give you the asset. Saving cannot give you the passive income. Even if it gives you passive income, it will not be enough for your expenses. If I talk about last 12 months of average inflation, the data published by government, it is 6.17. If I talk about the present FD interest rate is approximately 7.25. Inflation is 6.15, means you are earning hardly 1% only. So say, for example, if you invest into FD, 100 rupees, if you invest into FD for 10 years, after 10 years, your FD's value will be 201 rupees, considering 7.25% FD interest rate. But at the same time, the product or the commodity which is costing you 100 rupees today will cost you 181 after 10 years because of the inflation which I have considered is 6.17% only. So you might feel that your money has got doubled, your 100 rupees has become 201 rupees, but your profit is not 100 rupees. Like normally, how do we calculate profit? Right? Current value minus invested value. So current value is 201 after 10 years. 201 is the current value, and before 10 years you invested 100 rupees. So you might say that I have earned the profit of 101 rupees, but your actual profit is not 101 rupees. Your actual profit is what? 201 rupees minus 181, means your actual profit is only 20 rupees. Now if you understood the concept of real return, please type RR in the chat box. Not RRR, only RR. Please type RR in the chat box. Right? Again, and when we talk about real rate of investment, apart from FD, you also need to consider taxation, right? If you talk about the taxation, like if somebody is falling in the 30% of tax bracket, then in fact the real rate of return will be negative. After paying 30% tax to government, you left with 164 rupees. So if you invest 100 rupees, its value is going to be 164 post tax. But because of inflation, 100 rupees cost has increased to 181, means you have lost money. So a lot of people tell me, Jigar bhai, I don't want to invest into any volatile asset class like equity, or I don't want to take any market risk. My money is safe into FD. I don't agree that money is safe in FD. And here we have considered only 6.17% inflation. Tell me very honestly, hands on your heart, and tell me very honestly, how many of you would agree if I say real life inflation is much more than the government's published numbers? If government is saying 6% inflation every year, then real inflation is much higher. If you agree, please type agree in the chat box. If you agree, please type agree in the chat box. Come on, guys. Real inflation is much more than. How much is the real? For you and me, the real inflation is what? If your current monthly expense is 100 rupees, after 1 year, if your monthly expenses increased to 110, for you and me, inflation is 10%, not the 6% which is told by government. And I have traveled across the country, starting from Gujarat to West Bengal, from Srinagar to Kerala. I have addressed 2.5 lakhs plus investors in my physical live seminars, in the auditoriums, right, in the town halls. And I've asked this question to my live audience that how many of you would agree? And let me ask this question to you, by the way. Let me ask you the same question, right? Just listen to my next question. Rather than question, let me give you a sentence. Listen to my sentence very carefully and tell me if you agree. All of you are having a different income. All of you have a different lifestyle. You and me have a different lifestyle. Everybody has got the different lifestyle. Everybody has got the different, monthly expenses. But how many of you agree if I say our monthly expenses gets doubled every 5 years? If you agree, please type 5 in the chat box. If I tell you our monthly expenses gets double every 5 years, please type 5 in the chat box. And throughout my career, when I traveled across India and asked this question to 2.5 lakhs investor, everybody agreed that their expenses are getting doubled every 5 years. So if your expenses are getting doubled every 5 years, it means in real life you are facing the inflation of more than 14% per annum. And if your inflation, real life inflation is 14%, your FD is giving you 7% return. How can we even say that FD is safe? Yeah, if your investment horizon is just 1 year, it is fine. FD is fine. But if you're investing for 10 years, then every year inflation will eat up your money by 14%, and every year FD will give you 7%. Net, you are earning minus negative 7% return every year, and that too for 10 years. Compounding effect will be very, very, very scary. So let me give you an example. Right. If you invest, say, for example, if you invest 100 rupees today in FD, right, it will get doubled in after 10 years. But if your monthly expense is 100 today, after 5 years, it will be 200. Another 5 years, it is going to be 400 rupees. So your current monthly expense of 100 rupees will become 400 after 10 years, and FD's current 100 rupees investment will become 200. Tell me, has your money got doubled, or it has gone down by 50%? I'm getting it. So you need to get 14-15% kind of an annual return if you want to safeguard your saving and create a asset which can give you the passive income. And that kind of 15% kind of a return can be given by equity. And that history is historically, if you see, since the date of birth of Sensex, which is 31st March 1979, Sensex, the base value was 100 rupees. Today it is more than 65,000 rupees. It means on an average, Sensex, yani ki equity, means equity has given the return of 15.76%. And to double your money every 5 years, you require about 14.5% kind of a return. So yes, at 15.76%, your money can comfortably double every 5 years, right? And little bit, even it would be even something better than double after 5 years. So equity has that potential, but equity also has a risk. We started by saying that we want safety first. Warren Buffett said safety first. I am saying safety first. You are saying safety first. And to safeguard your money from inflation, only way which is visible, practical for everybody is equity. But equity is also risky, because when we talk about equity, one thing we always remember is mutual fund investments or security market investments are subject to market risk. So what about market risk? We want to safeguard our money from inflation, but if we try to safeguard it from inflation, market risk might hamper our portfolio negatively. So let's understand this market risk first. See, we are just talking about some practical basic fundamentals initially, so that whenever I give you some exact practical ideas about implementing a strategy which can help you to become financially free, right? So those strategies will take hardly 15 minutes to explain. The strategy, how to become mathematical strategy, will take only 15 minutes for me to explain you how to achieve financial freedom. Do this. But those 15 minutes of exercise requires some groundwork. So that requires some strong foundation. We are right now building a strong foundation. Right. So let's understand market risk first. What is market risk? You invested today, tomorrow market went down and your portfolio went down. That is market risk. So we have done the analysis of Sensex from 1979 till 2023. If you check the 1 year return of Sensex every year, means return of Sensex from 1979 to 1980, 1980 to 1981, year 1981 to year 1982. If you talk about the 1 year return, out of 44 times, Sensex has given 14 negative return observations. So 14 out of 44, you would have got negative return. You would have lost your money because of market risk. Means probability of losing money in 1 year is 31.82%. But if you increase your investment horizon from 1 year to 3 years, the same probability will decrease from 14 out of 44 to 7 out of 42. So your probability of losing money has gone down from 32% to 16%. 3 years means what? You invested in 1979 and you withdrew after 3 years. Means in 1982, you withdrew your money from Sensex. Then somebody who invested in 1980, he withdrew the money in 1983. Somebody who invested in 1981, he withdrew his money in 1984. So if we talk about 3 years period, there are 42 observations, out of which seven are negative. If we talk about 5 years, only 2 out of 39 is negative. Means out of 39 times, you will earn for 37 times. There are only 2 times where you might lose some money. So losing money, the probability again went down from 16% to 5%. 10 years, only 1 out of 35 is a negative period. For 15 years, 0 out of 30. For 20 years, 0 out of 25. It gives me, it gives me only one conclusion, that stock market is definitely risky. Tomorrow you can't, like, nobody can guarantee you. If you invest today, nobody can give you the guarantee that whether tomorrow market will go up or down. Right? Yeah, I can predict. About tomorrow. Tomorrow market is going to be closed because it's a Sunday. But on Monday, you don't know. There is a 50% probability of market going up, market going down. But if you talk about the long-term horizon, one thing is very sure, that whenever you increase your investment horizon and equity, risk starts getting reduced. Risk start getting reduced. So if you want to beat inflation, if you want to invest into equity, the first rule which you need to understand is, and I would request all of you to please write down these rules if you want. The first rule is, don't put all your eggs into one basket. I'm sure you know this, and you might already been following this. You should not invest everything in one place. You should have everything in your portfolio. You should have equity. You should have debt. Debt means interest generating, fixed income generating securities. FD is debt. PPF is debt. Debt mutual funds are debt. Right? So money should be in equity also. It should be in debt also. But how much money? Which money should be invested into equity? Which money should be invested into debt? The first rule is, when you invest, ask yourself this question. Ask yourself this question: for how many years I'm ready to stay invested. So if your investment horizon is less than 3 years, you should not invest into equity market or equity mutual fund, because that's very risky. In 3 years, we know probability of losing money is 16%. Probability of earning money is 84%. 7 out of 42 is a probability of losing. It means 35 out of 42 times you will earn also. But again, 3 years is not the ideal period for equity. Up to 3 years, inflation risk is not a big risk. Inflation is a big risk when you're investing for 10-15 years, because every year inflation will eat up your money little by little, and after 10-15 years the compounding negative impact will be more. So in short term, market risk is high, inflation risk is low, so you can invest your money into debt mutual fund. 3 to 5 years is a medium term. So when you're investing for 3 to 5 years, you should put some money into equity, some money into debt. And if you're investing for more than 5 years, you should invest into equity. But it is easier said than done. When you invest into equity, journey is not going to be very comfortable. Destination will be definitely like after 5 years, 10 years. If you invest today, after 5 years, after 10 years, you will be happy. But the journey might not be very beautiful journey. Journey might not be comfortable. All right. You need to focus on destination, because in equity, your money doesn't grow in a straight line. It doesn't increase every year in a straight line. Sometimes market will go up, your portfolio will go up. Sometimes market will go down, your portfolio will go down. So in between, you need to remember that in between, the journey is going to be a painful journey. And you need to stay invested. If you don't stay invested during this painful journey, then even after investing into equity, you'll lose money. You'll convert your temporary losses into permanent losses. Right? So say, for example, you invested, let's remember the 2020 COVID time. During COVID time, there was a big market correction. I hope all of you understand this word, market correction, right? So during market correction, market went down to 26,000. Sensex was 26,000 in 2020. And when you face any such correction, you'll be scared. Not only you, even I will be scared. You and me, when we look at our portfolio during the market correction, we get scared. And due to this scare or due to this fear, sometimes we take the wrong decision of selling the portfolio, redeeming the money, taking the money out of mutual funds, taking the money out of equity. That is the biggest mistake which you could do in equity. And the name of mistake is withdrawing in panic due to market correction. So remember one thing, if you invest into equity for long term, you will get a wonderful return. 15% kind of a return has been delivered by equity since last 42 years. But for that, you will have to go through ups and downs. It is just like an aircraft. Say, for example, you are in an aircraft and there is a heavy turbulence. Heavy turbulence, you might get scared. But no matter how how scared you are, you're never going to jump out of the aircraft because you trust three things. Number one, you trust aircraft. That aircraft is built to withstand any such turbulences. Second, you trust pilot because you know that the pilot who is navigating your aircraft is the experienced one, is the trained one, has got the experience of flying aircraft for thousands of hours. And third, you also know that there is a co-pilot who is there who can help pilot to navigate through this situation. And because of that, even after having a lot of fear, you don't try to open the door and jump out of the aircraft, right? Because you know if you jump out of the aircraft, you will definitely die. Similarly, during market correction, you might get scared. But if you jump out, then definitely there is going to be a loss. But if you stay invested, if you stay invested even after that fear, then only you will be able to create wealth in long term, right? But how to do that? Because in aircraft, we know aircraft is designed perfect, to withstand such situation. There is experienced pilot, there is a co-pilot. But what about equity? How do we convince ourselves to stay invested in the equity during such turbulence, right? First of all, let me give you the rationale why you should stay invested, because we have seen plenty of corrections in the market in history. There were times when market went down from 21,000 to 8,000 in less than 1 year in 2008. And there are many corrections in past. But if you look at the history teaches you only one thing: correction is temporary, growth is permanent. So when you invest anywhere to build an asset, to earn passive income, to become financially free, during your investment journey, you need to ensure that you remember this mantra of correction is temporary, growth is permanent, so that whenever you implement the strategy which I have not yet taught you, I'm going to teach you the strategy to invest which can help you to become financially free, and that too very easily. But to stay focused in that journey, you should remember this mantra: correction is temporary, growth is permanent. So stay invested in equity for longer period of time. But again, when we say equity, it is easier said than done that in long term equity gives you always a good return. Equity means not all equity shares, not all companies. When I say in long term equity will give you a better return, I'm talking about a portfolio. Sensex is a portfolio, Nifty is a portfolio, mutual fund scheme is a portfolio. I'm not talking about individual stock. In individual stock, even after 20 years, you might lose the money. If we look at the data, historical data, which I've taken from the BSE's website, in BSE website, I downloaded the data on 29th of June 2023. There were 4,083 active stocks. Means there were 4,083 listed active stocks. On the other hand, there are 4,035 stocks or companies which are delisted from the stock market. There are 1,218 companies which are suspended from trading in stock market. Total 9,336 companies. And if you look at the probability, right, if we do the probability analysis, out of 9,336 companies, 44% companies are live. Rest of the 43 plus 13 means 56% of the companies are not there in the market. So if you invest into individual stock, out of 100 companies, 56 companies might not be in existence even after 5 years, 10 years, or maybe whatever your investment horizon is. Only 44% companies will be actively traded in future. And out of this 44% companies also, out of this active listed stocks, 4,083 stocks, every company is not going to give you a better return. In some companies, even after 10 years, 15 years, 20 years, you might have to face a loss. So when we say you can invest into equity for long term, you will earn the money. I'm not talking about individual stock. I'm talking about Sensex, Nifty, mutual fund portfolio. Why portfolio? In portfolio, probability of losing money is very, very less. If I talk about BSE Sensex, let me give you interesting data. These are the 30 companies which were part of BSE Sensex, BSE 30 in 1986. In 1986, these were the 30 companies which were part of BSE Sensex. Out of this, only 7 companies, not 7, maybe eight. Huh. Only eight companies of the out of the original 30 members of BSE 30 are part of Sensex today. Sensex means BSE 30. Sensex is constructed based on the top 30 companies. So top 30 companies of 1986, all those 30 companies are now right now not in top 30. Only eight companies are part of Sensex. 22 companies are have left the Sensex, right? So this data which I'm showing you might be a little bit scary. On one hand, I'm saying that invest into equity for long term, you'll make money. On the other hand, last two slides which I've shown you are very scary. Like there is no guarantee that the stock which you're investing into will be even listed after 10 years. There's no guarantee. It could be it could get delisted, or it could be suspended also in future. And even if it is live, there is no there is no guarantee that this stock is going to be in top, right? So now we are confused. Should we invest into equity or should we not? Definitely we should if you have a good aircraft. If you have a good aircraft, it can help you to go through these ups and downs of market, and the name of that aircraft is mutual fund. When you invest into mutual fund, there is a structured portfolio, and when you invest into structured portfolio, the chances of losing money compared to equity stock is almost next to nothing. So these are the various categories of mutual fund schemes. Say for example, flexi cap fund category, ELSS यानी कि means tax saving category, large cap funds, mid cap funds, multi cap funds. These are the various categories of mutual fund, right? And if you look at the historical last 10 years return, then just look at this lowest return. Forget about highest return. Look at the lowest return. There are 16 flexi cap funds in India of various companies. Even the worst performing fund has given 10.65% positive return. Because there is not a single flexi cap category fund which has given you negative return. There is not a single ELSS scheme which has given you negative return. Even lowest performing scheme, worst performing scheme has given 13.11% return in last 10 years. Look at this entire row of lowest return. Not a single company has given you negative return. If you look at average return is more than 12% in almost all the categories. If you look at the schemes which has given better return, it is 18-20% kind of a return. So when it comes to mutual fund, it's such a beautiful aircraft. It's a beautiful mechanism which can withstand any kind of a market volatility and give you a better return in longer term. Why? Because there is a pilot. There is a pilot called fund manager who has got the experience of so many years, like maybe 10 years, 20 years, a lot of experience he is having. Then his full-time job is this portfolio management. His experience, who has got the degree, he has got the knowledge, he has got the education, he has got the resources to do the research so that your portfolio doesn't give you negative return in long term. So compared to stock market, the return of getting a negative return in mutual fund is almost nothing when it comes to 10 years investment. So mutual fund is a kind of a aircraft which can help you to pass through or navigate through any kind of a market turbulence, but not in a short run, in a long run only. 5, 8, 10 years kind of in 1 year, 2 year, you might get negative return in mutual fund also. You should not worry. You should not jump out of the aircraft of mutual fund at all. All right. So that's the second learning. The third learning is when you invest into equity market or mutual fund, never try to time the market. See, the formula of getting independence will take only 15 minutes. Not even 15 minutes, might take only 10 minutes. Right? I'll tell you, do this, and you'll become financially free in next maybe 8 or 10 years. Or maybe 15 years for in somebody's case. That formula is very simple, easy to understand, and easy to implement. But you will not be able to implement it properly without clearing your basic fundas about the equities, mutual funds, and financial literacy concepts. So third thing which I would like to talk to you is don't try to time the market. Means what? Never place your bet looking at the index. Never guess. Never say that, okay, I'll invest it when the Sensex comes to 60,000 level. I will withdraw my money when Sensex goes to 70,000. So every time doing the market timing while investing or profit booking is called market timing. Don't do that. Why? 1 lakh rupees invested in Sensex in 2003 has become 14 lakhs in 2023. In 20 years, 1 lakh has become 14 lakhs. But provided you have stayed invested for 20 years without leaving the market. But what if you have booked profit in between? You stayed out of the market, you again entered the market, you did the market timing, And let's assume that during the market timing, you lost the two best days of the market in last 20 years. In last 20 years, there were some good days when market went up. There were some bad days when market went down. But when market went up, that was a good day. And out of all the good days, when the market went up with the highest percentage, was the best day. So let's assume you did the market timing, you booked the profit, thinking that market will go down and I'll reinvest again. But instead of market going down after your profit booking, market went up. And that was the best day. Let's assume you missed the best day. You lost only 2 days really. Out of 20 years, you stayed invested for 19 years, 11 months, 29 days. You only lost 2 days. And those 2 days were best days. Then your 1 lakh will become 10.96 lakhs instead of 14 lakhs. Your loss is 3 lakhs. And your investment was just 1 lakh only. If you lose best 5 days, instead of 14 lakhs, your 1 lakh rupees will become 8 lakhs 71,000. If you lose 10 best days, your 1 lakh rupees will become 6.32 lakhs. And if you lose 40 best days out of 20 years, your 1 lakh will become 1.47 lakhs. So what I'm trying to say is, don't try to time the market. This is just a theory. This is just a theory. But based on this theoretical analysis, I came to 4 practical conclusion. Conclusion number one. 1 lakh has become 14 lakhs in 20 years, but not in a straight line. There were only few days which were very, very, very important for this growth. In last 20 years, there are only few days because of which this entire growth has come. If you agree, then please type agree in the chat box. If you agree with this conclusion, in equity market, all days are not equal. There are few very important days where you need to stay invested. If you stayed invested on those days, then only you will make a profit. If you agree, please type agree in the chat box. Second conclusion. In future also, when you invest today, this is the past data, but let's talk about future. In future, if you invest today, in next 10 years, whatever wealth you will create will be because of some few selected days only. In next 10 years also, market is not going to go up in a straight linear fashion. If you agree with this conclusion, then please type agree and then 2. 2 means numeric 2. Third conclusion. You can find out the best days of last 10 years from the BSC's website. You can find out the best 40 days of last 20 years from the BSC website, but you cannot predict which are going to be the future's best 40 days. If you agree, then please type agree and then numeric 3. Third conclusion. If you agree, please type agree and 3. And let me give you the fourth and the last conclusion. The last conclusion is that if you keep doing the market timing, if you keep doing the profit booking again and again, then there is high probability that even if you don't miss all 40 days, but your probability of missing some of these best days will increase. If you constantly do profit booking re-entry, then your probability of losing money will increase. Probability of losing best days will definitely increase. If you agree, please type agree and 4, numeric 4. Please type agree and numeric 4 in the chat box if you agree. So these are the 3 conclusions which I came to. And when you invest in equity, just give it a time. And especially when you do SIP, how many of you know SIP? If you know SIP, then please type SIP in the chat box. I'm sure all of you know what is SIP. SIP is not a scheme, by the way. Let me tell you, SIP is not a scheme. SIP is not a mutual fund scheme. SIP is the way of investing into mutual fund scheme. A way of investing into mutual fund. If you invest one time, it's called lump sum investment. If you invest every month, if you invest fixed amount through auto debit, it becomes SIP. So SIP is a route of investing into mutual fund, not the scheme itself. It's a way of investing into mutual fund scheme. There you don't have to worry at all about market timing. Even if you are the most unluckiest investor on the entire planet Earth, then you don't have to worry about market timing, market levels when you invest through SIP. And SIP is one of the best way of investing and building a portfolio to become financially free. I give the formula also, how exactly can you retire with the help of SIP, how exactly can you become financially free. With the exact calculation I'll tell you. But before that, let me tell you, even if you are a most unluckiest investor on the earth, but if you do the SIP for a longer period, you'll get a good return. Let me share some analysis. Last 10 years of Sensex data, I taken it from the BSC Sensex. And every month, let's say there is an investor who is the most lucky investor. Luckiest investor means what? Luckiest investor means what? Luckiest investor means that investor. Just hold on. Okay, there is a spelling mistake. Just ignore it. I just missed EST. I missed T. But anyways, the meaning will not change. Luckiest investor is the investor who did the SIP for 10 years in Sensex. But every month, his installment, his investment was done on the lowest Sensex of the month. Lowest Sensex means what? Whenever I'm investing, I'm getting a cheaper Sensex. So whenever you invest, and if you get the most cheapest Sensex of entire month, whenever your installment gets hit in a month, whenever your money is getting debited from the bank account and is being invested into mutual fund or equity, on that day the Sensex is lowest in entire month. It means you are luckiest. You bought the Sensex for 120 months, and that too at the lowest price. So when you invest on the lowest price, you're lucky investor. Then SIP return in Sensex is 13.37% in last 10 years. Let's talk about a random investor. Random investor means what? Investor who is investing into Sensex every month through SIP. Let's say every month means SIP, but he is investing at the closing of the month, means last working day, 30th or maybe 31st of the month, he is investing fixed amount in Sensex. That's also SIP. Investing fixed amount in something is called systematic investment. So you're investing at the end of a month. Your return is 12.56%. And now let's talk about the third investor, who is the most unluckiest investor. Most unluckiest investor means what? Whenever his installment is due, market is making a new high for the month. So he's buying the Sensex, costliest Sensex of every month is buying since last 20 years. So whenever his investing prices are high, when you invest and prices are high, you're unlucky. When you invest and prices are low, you're getting cheaper. It means you're lucky. So what about unluckiest investor who is investing at the all every month? He's investing in the high of every month. His last 10 years SIP return is 12.05%. So if you're luckiest investor, if you do SIP, 13.37% return. If you're a random investor, you'll get 12.56% return from Sensex. And if you're even the most unluckiest investor, still you would have got 12.05% return, CAGR. So one thing is very clear: when you invest into mutual fund or equity through SIP route, that SIP route is so beautiful that even if you're the most unlucky investor, you'll create a wonderful wealth and returns are going to be positive. So don't try to time the market. Never try to do the analysis of which is the best day to start the SIP. Any day is the best day to start the SIP. The only thing is you need to continue it for 8 years, 10 years, 15 years kind of a period. If you continue it for the longer period in long term, whether you are lucky or unlucky or random investor, there won't be much difference in the return. Yeah, there's going to be some difference, right? But you can't predict the high and low of the month. This is just a hypothetical data. Hypothetical luckiest investor, hypothetical unlucky investor. Unlucky investor is also making 12% kind of a return for 10 years. So SIP is the best way, and from there you should not try to time the market. If you look at the SIP returns of various categories, for example, let's talk about 5 years return. 5 years return means 5 years SIP return. So if you talk about 5 years SIP return, all right, let me highlight it. For large cap category, the best performing scheme has given 19% return. Average performing scheme has given 14% return. Even the lowest, which worst performing large cap scheme has also given 11.56% in 5 years period had somebody invested in a SIP. Look at mid cap. Highest is 26.97, lowest is 14%. Look at this lowest return. Not a single scheme. You lost money. Average return is more than 12-15%. And best performing scheme has given better return. All right. If you look at 10 years return, let's forget about 5 years. Let's look at the 10 years return. Look at the lowest performing scheme. It has given a double digit kind of a return. Look at the 15 years return. Even the lowest performing scheme has given on an average 12 to 15% kind of return. In just couple of instances, lowest performing scheme in a category has given 9.75% return. So this is the power of SIP. Invest into equity for long term, it will beat inflation. But when you invest into equity, equity is risky, market risk is there. So invest for long term. When you invest for long term, don't try to time the market and do the SIP. If you remember these things, this is a summary of what we have discussed in last few minutes. We are going to the next agenda, but before that, if you understood this entire practical aspects of equity investing and how risk can be reduced, with the help of mutual funds and with the help of SIP. Please type I in the chat box. If you understood, please type I in the chat box. Now let's talk about financial freedom. If you want to become financially free, if you want to achieve financial independence, the first rule you need to follow is income minus saving is equal to expense. Most of the investors, most of us, we do other way around. We have some income, say for example, we got the salary, we spend something, and after spending, after all the expenses, if something remains, that is saving for us. So 90 to 95% of the people, income minus expense is equal to saving. But the actual formula, the true formula which can help you to achieve financial freedom earliest in your life, is income minus saving is equal to expense. Means first you need to decide how much you need to invest and save for achieving financial freedom. So whatever your income is, keep this saving aside, and then whatever money is left, do your expenses. So income minus saving is equal to expense. This is the first mantra which you need to keep in mind if you want to become financially free. And when it comes to financially free, remember one thing: when you are traveling into aircraft, na, always this air hostess, the big in beginning they give you a lot of instructions, and during those safety instructions they tell you put on your own oxygen mask first before assisting others. So in case of emergency, oxygen mask will drop out automatically. Please wear your mask first before assisting somebody else. Why? Because if you are safe, then only you will be able to help others. The same way, while investing, right? We invest for a lot of things. We invest for our own independence, means our own retirement. We invest for our kids. We invest for our buying a home. We invest for buying a car. But out of all these goals, if you want to become financially free, the most crucial goal is your own retirement. You need to plan your, you need to plan for your retirement first, then comes the rest of the things. So when should you start investing for retirement? The answer is very simple: from the very first day when you get your salary. If you invest 20 to 30% of your salary from a very first day when you get your first salary, it will hardly take 12 to 15 years of time to become financially free. I started my career in 2002. In 2016, after 14 years of my career, when I was 34 years of age, I became financially free. I left the job, which was paying me almost, 30 to 35 lakhs rupees every year. I left the job because I became financially free. I started my SIP at the age of 22. I consider myself very lucky. Why? Because I started my career in mutual fund industry. I earned a lot of money, but I'm not lucky because I earned a lot of money. I'm lucky because in mutual fund industry, when I started my career, apart from money, I also got one thing which is very, very, very valuable, which is financial literacy. I got financial literacy. Somebody explained me the power of concept of compounding SIP when I was 22, and I started investing 35% of my salary every month through SIP. I continued this whenever my salary increased from 8,000 to 12,000, 12,000 to 18,000, 18 to 25,000 to 1 lakh to 2 lakh. I kept on increasing my SIP. My funda was very simple: 35% of my SIP should be there for my retirement, for my financial freedom. At the age of 34, at the age of 34, my portfolio was so big that even if I withdraw just the profit out of my portfolio, it would be more than my salary. So I became financially free that way. Right. So you need to focus on being retired first. If your retirement is safe, India is a kind of a country where there is no social security. There used to be a social security structure before 20-25 years in India, and that structure was a joint family structure. Joint family structure itself was a kind of a social security. But now joint families are getting broken down into various nuclear families, so you can't depend on your kids for your retirement. If you agree, please type agree in the chat box. You can't depend on a government also. Government is not going to take care of you during your retirement. You will have to create your own portfolio which gives you the return every month in terms of passive income to become financially free. And there was this survey which happened. I read this survey in Economic Times. 4 in 5, right? 4 in 5 people feel that they should have planned earlier in their life as far as retirement is concerned. When there was a survey which was done for the retirement readiness survey, out of 50 people, 5, right? Sorry, out of 50 people, 40 people said that they were late in planning for retirement. Because when you start your career at the age of 22, 25, you think that, oh, there is plenty of time before I retire, before I become financially free. So let me enjoy my life. You live only once, and you start spending your money on your EMIs, on your phones, on your car. I'm not saying don't buy car, don't buy mobile, right? They're earning because we want to enjoy the lifestyle, we want to increase the lifestyle, but not at the cost of your own financial freedom. You need to first put aside 20 to 25%, or maybe in my case, I followed the thumb rule of 35%. If you can do that, that's best. But if not, then minimum 20% you should invest every month for your retirement, for your own financial freedom. And if you subconsciously, if you are comfortable, if you know that your retirement is secured, you're not going to be dependent on your kids or government during your retirement, then you will be very confident. You will be able to help your family also. You'll be able to fulfill their dreams also, because you know your retirement is safe. So please put on your mask first before helping others. Means pay yourself first. Every month, some percentage of your salary should go into investment in creating some portfolio which can give you passive income for your retirement. And that retirement doesn't mean that it should come at 55 years of age or 60 years of age. You can also early retire. The way I retired at 34. Retirement doesn't mean that I left working. I'm still working. But right now I'm following my passion. I'm spreading financial literacy, and that is my passion. Right. I got financially free at the age of 34 because of my portfolio. And as far as retirement planning is concerned, the best solution which can help you to become financially free, getting financial independence, is the combination of SIP and SWP. I'm sure all of you know SIP. How many of you know SWP? Please type SWP in the chat box if you know SWP. If you know SWP, please type SWP in the chat box. Come on, guys, if you know it. If you don't know, then please type NO in the chat box. If you're not aware about SWP, then please type NO in the chat box. Okay, so Pradeep is saying no. Thank you very much for honest feedback. So Pradeep, and all those people who don't know what the SWP is, let me tell you, it's a reverse SIP. Now, what is reverse SIP? In SIP, every month, a fixed amount gets debited from your bank and is invested into mutual fund. So you are giving fixed amount, small amount every month to mutual fund scheme, and the end of a tenure, you're getting a big chunk from mutual fund to your bank account. In SWP, it is reverse. You have a big chunk of money which you're investing lump sum one time into mutual fund and signing the form of SWP. SWP means you're withdrawing fixed money every month, and that too automatically. So say for example, let's say I invested 50 lakhs rupees or maybe 10 lakhs rupees. I invested 10 lakhs rupees in mutual fund and said I want 6,000 rupees of SWP. So every month automatically 6,000 will be withdrawn and it will be credited to my bank account. So every month regular income will start in the form of monthly fixed withdrawal. If the rate of return in that particular month is more than withdrawal, then your portfolio will increase. Your 10 lakh might become more than 10 lakh. But say for example, in that particular month, the profit was only 3,000, but your SWP amount was 6,000. In that particular month, your portfolio temporarily will go down by 3,000 rupees. But if your portfolio is in a long term is giving you 10-12% kind of a return, and if you're withdrawing at the rate of 6-7%, it means you are going to get a wonderful source of passive income in terms of SWP. So SIP and SWP is a wonderful way of planning your retirement. Why? Let me give you an example. Let's say there is a person called Prashant. His age is 28 years and he starts investing 10,000 rupees every month till the time he retires. Let's say he wants to retire at 55. And let's say you are Prashant and your age is 28 years. And if I tell you, invest 10,000 rupees every month till your retirement, and after retirement, you'll get 1 lakh rupees every month, and that to lifetime. How does it sound? If somebody gives you such offer that invest 10,000 rupees every month, and when you retire, after retirement, you'll get 1 lakh rupees every month as an income, and that to perpetual till the time you live. And if you don't want that 1 lakh rupees monthly income, then you can also withdraw lump sum portfolio amount also. How does it sound? How does it sound? Tell me. How does it sound? Good or bad? Sounds good? Sounds good? Please let me know through chat box. Sounds good? Right. Now this seems a little bit of exaggeration, right? Like investing 10,000 and creating a pension of 1 lakh and that to lifetime. How is it even possible? Okay, forget about that possibility aside and tell me, how many of you agree that from SIP in long term you can achieve 12% kind of return? If you're confident that SIP is from equity mutual fund can give you at least 12% return in long term, then please type 12 in the chat box. If you at least comfortable with 12% rate of return, please type 12 in the chat box. So you're comfortable, right? You're comfortable 12 with the 12% return. So let's say you invested 10,000 rupees every month starting from 28 years till the age of 55. Your corpus means your portfolio will rise to 2.16 crore, assuming 12% rate of return. And you can find out this value in Excel also, from the mathematic books also. You can apply the formula. 10,000 invested every month for 27 years, assuming 12% rate of return, will become 2.16 crore rupees. Now let's assume you invested into equity, you got 12% return. Now you want to retire and you want monthly income. And when you want monthly income, you don't want that market volatility of equity. So post-retirement, you will safeguard your portfolio. You will invest less into equity, more into debt. So let's assume you are investing this 2.16 lakhs rupees in a debt mutual fund. Once you are retired, you are transferring this money from equity mutual fund to debt mutual fund. And how many of you agree that debt mutual fund can at least generate 6% kind of a return? If you agree, please type agree in the chat box. Debt means those investments which generates a fixed income, interest income. And if a mutual fund is investing into fixed income, it is called debt mutual fund. So debt mutual fund, it can give 6% kind of a return, right? So 2.16%, considering 6% rate of return and doing the exact amount of SWP, based on 6%, you can withdraw 1,08,000 every month. Still your capital will remain 2.16 crore. It will not reduce, because there is a return which is 6% and you are withdrawing same amount at the rate of 6%. So 6% annually means what? Approximately 12,96,000 in this case. So 12,96,000 means monthly 1,08,000 you can withdraw, and still your portfolio will be as it is, 2.16 crore. And whenever you want to stop receiving the money, just give a note, transaction request to mutual fund that now I don't want this 1.8 lakhs, 08 lakhs rupees every month. Give me my lump sum back. Then you will get 2.16 crore back, assuming 12% rate of return before retirement and 6% rate of return after retirement. So this is one of the most beautiful solution. You don't require any specific pension plan to plan your retirement. You can create your own pension plan by investing into SIP from your first paycheck till the time you retire. And if you missed that first paycheck investing, that was the best time to invest for you. But if you have missed that, then the second best time is now. Don't delay. Don't delay. We human beings have got the habit of delaying the good things because we don't get the instant gratification. And that's why we delay. Okay, I'll start it from tomorrow. I'll start it from next month. I'll start it. Definitely, I'll start it after 3 months. Whether it's exercising, investing, following a good habit, sleeping early, waking up early. These are good things, but we don't follow through. Most of us don't follow through because we don't get the instant gratification. Similarly, investing every month, right? Investing every month. It's good, but you're going to get the benefit after long period. So you might not get that much motivated. But when you click on the SIP, it automatically invests your money every month without you even doing the transaction, because it's in auto mode. So SIP and SWP combination is the best combination for your retirement. But again, there are some practical difficulties which we need to discuss. It means you need to do the SIP. After a certain period of time, you need to, once your SIP stop, you need to switch your portfolio from one scheme to another scheme. And third, you need to give the SWP request. Operationally, it is difficult to remember. Well, now let me switch the money. Let me start, this SWP mandate. So operationally, it is difficult. Everybody knows that this is a wonderful combination, but still we don't follow through. And there comes into the picture the concept of freedom SIP. So freedom SIP is something, it's a feature which ICICI Prudential Mutual Fund has launched. What is it? It's a combination of SIP and SWP. Say, for example, you want to have a combination of SIP and SWP for generating a passive income in future. So first thing you need to do is select any scheme. Say, for example, you selected ICICI Prudential Mid Cap Fund or Small Cap Fund or Large and Mid Cap Water Fund. It gives you the option of selecting one period out of this. Either 8 years, you can choose 8 years of period, you can choose 10 years of period, 12 years, 15 years, 20 years, 30 years. You need to select one, or maybe 25 years. Sorry, bad thought. right? So freedom SIP is a concept where operational worry is taken care of. Now, when you can do normal SIP or freedom SIP in the same scheme. Return will be same. Rate of return, NAV growth will be same whether you go for the normal SIP form or you fill up the freedom SIP form. But in freedom SIP form, you can select one out of all these options given: 8 years, 10 years, 12, 15, 20, 25, or 30 years. Once that period is over, your automatically SIP will stop. Automatically money will switch to another fund. Automatically SWP will start even if you forget. After 8 years, let's assume that you forgot that your SIP has stopped and you need to now go and start the SWP. It will automatically happen. Automatically SWP amount, automatically monthly income will start. How much? Say for example, if your SIP period is 8 years and if you go for freedom SIP, after 8 years, if your SIP amount is 10,000, after 8 years, your SWP amount will be 10,000. Means if you invest 8,000 to 10,000 rupees every year, every month for next 8 years, after 8 years, you will start receiving 10,000 rupees every month as a SWP. Consider it as a passive income. If you go for 10 years, right, in that case, if your SIP amount is 10,000, then your monthly income through SWP will be 15,000 after 10 years. If you select the option of 12 years, then for 12 years, you will invest 10,000 rupees every month. After 12 years, your investment will stop, but your withdrawal will start. In 12 years, your monthly SWP amount will be twice of the SIP amount. If you go for 15 years, your SIP amount is 10,000. After 15 years, your SWP amount, monthly withdrawal amount will be 30,000 automatically. If you invest 10,000 rupees every month through freedom SIP, select 30 years. After 30 years, your monthly withdrawal will automatically start, which is 1.2 lakhs rupees every month. So freedom SIP is a wonderful concept. Why freedom SIP is a wonderful concept? If you invest into normal SIP, when you receive the statement, it would either give you there's a positive return or it will give you negative return. In short term, let's say your market went down by 10%, your portfolio went down by 10%. In normal SIP, you might get scared. But here in this freedom SIP, you know that after 8 years, you are going to get 10,000 rupees every month, or maybe after 12 years, you're going to get 20,000 rupees every month. You know the end result after 8, 10, 12, or maybe 30 years. And that's why it will be easier for you to stay invested. So discipline will be automatic when you invest into SIP through freedom SIP. Right. So, what are the schemes which you can target? You can say, for example, you can target any scheme. You can invest into any scheme. Which scheme should you invest into? Large cap, mid cap, small cap? That's a different question. I'll try to answer that at the end of a session. We're about to close this session in next 10 minutes and then we'll open the Q&A session. But before that, let me tell you, you can select any equity scheme. Say, for example, you want to start SWP, right? Freedom SWP, Freedom SIP. So there is a form. You select this Freedom SIP. You selected the ICICI Prudential Flexi Cap Fund. So your SIP will start in Flexi Cap. After the end of the tenure would be either 8, 10, 12, 15, 20, 25 or 30 years, whichever you need to select the tenure. Say, for example, 15 years, right? And today only you need to tell them which fund you want to transfer your money after the period. So you can transfer into any of the hybrid fund, multi-asset fund, equity and debt fund, asset allocator fund. Now this equity category funds has got the probability of giving you 12% kind of a return in long term. This is the hybrid category fund. Hybrid means what? They're investing into equity also, they're investing into debt also. They can give you 8-10% kind of a return in long term because it has equity also, it has safety also. So it will not give you returns like equity, but it will also give you safety compared to equity. So let me show you some back testing of the actual schemes. Right, just hold on. Forget about scheme. Let's talk about the Nifty. So let's say Nifty 500. Had you started 10,000 rupees of Freedom SIP in 1998 for 8 years. So for 8 years means what? In 2006, your SIP will stop. Here your SIP will stop. Your 10,000 rupees SIP has given you 26.58% return and your investments portfolio value is 28.19 lakhs. Here your 8 years period was over in 2006. From there, SWP will start. How much? Your SIP was 10,000 rupees and your period was 8 years. So if the period was 8 years, then SWP amount is automatically 10,000, which is equal to your SIP amount. So you invested 9.6 lakh rupees. In 8 years, you invested 9.6 lakhs rupees. You withdraw from 2006 till today, till 2023, every month you kept receiving 10,000 rupees SWP every month. It means you withdraw total 20 lakhs rupees. Even after withdrawing this 20 lakhs rupees, current value is 28 lakhs rupees. It means you invested 10,000 rupees every year for 8 years. Your total investment is less than 10 lakhs. On the other hand, you already withdrawn 28 lakhs rupees. So you already withdrawn 20 lakhs rupees. And even after withdrawing 20 lakhs rupees, if you withdraw today, the entire money, today's worth is 28 lakhs rupees. Sorry, it's my bad. Let me revise the numbers. I thought there are some mistakes in the numbers. It was in my mistake was mine. 28 lakhs rupees was the value at the end of 8 years. At the end of 8 years, the value was 28 lakhs rupees. Now this 28 lakhs rupees, from here you started withdrawing 10,000 rupees every month because it's a freedom SIP. Automatically, when your period is 8 years, your monthly withdrawal will automatically start. So your monthly withdrawal would have started in what? 2008. From 1998, 2006, your monthly withdrawal has started. Your monthly withdrawal has started 10,000 every month. Today's worth is 1.13 crore. So you invested 9.6 lakhs rupees in 8 years from 1998 to 2006. From 2006 till today, you withdraw 28 lakhs, 20 lakhs 50,000 rupees. Even after withdrawing 20 lakhs rupees, your current portfolio value is 1.13 crore. This was 8 years. Let me tell you 10 years. 1998 to 2008, your 10 years period was over when there was a correction. In 2008, there was a big correction. So after 10 years of SIP, your portfolio value was 36 lakhs rupees. From 36 lakhs rupees every month, 15,000 SWP. Why 15,000? Because now your period is 10 years. When your period is 10 years, SIP amount is 10 years and SWP amount is 15,000. 10,000 and 15,000. Till now, you have withdrawn 27 lakhs. You invested 12 lakhs. Portfolio value was 36 lakhs when SIP was over in 2008. Till now, you withdraw 27 lakhs and current value is 1.1 crore. So you look at any period. I don't want to get into data for all the periods, but let's look at one last data. 20 years of freedom SIP. Had somebody started in 1995, 20 years would have finished in 2015. You did the SIP of 10,000 rupees and your value after 15 years 1.59 crore. In 20 years, your SIP value is 1.59 crore. From here, your SWP started. In 20 years, your SWP amount is 5 times, which is 50,000 rupees. If your SIP amount is 10,000, SWP is 50,000. So total investment in 20 years was 24 lakhs. Your portfolio value was 1.59 crore after the SIP. And from SIP until now, you have withdrawn 52 lakhs rupees, invested 24 lakhs rupees, already withdrawn 52 lakhs rupees. Current value is 3 crore rupees. Why? Because your return is more than SWP. You are withdrawing 50,000, but your portfolio is generating better return than 50,000 every month. On an average, better return every month. So your portfolio value currently is 3 crore rupees. So what I'm suggesting is, to become financially free, you should have a combination of SIP and SWP. And for that combination, I would strongly suggest you to go for the freedom SIP. Which scheme you should select, that depends on your risk profile, your age, your income. And for that, you need to take the advice of your financial advisor, your mutual fund distributor. Your mutual fund distributor can give you the best suitable scheme according to your risk profile, your age, your income, and everything. Because investing is just like buying a medicine. One medicine which could be useful for me for curing my allergy, right, might not be useful for my wife, even if she has the same problem. Because one drug, like say for example, there's a drug called amoxicillin. My wife, my family doctor always prescribes that particular antibiotic to my wife, amoxicillin. But if the same drug, if I take it, I'll get a great amount of allergy. I am allergic to that drug. So one drug which is good for you might be allergic to me. Similarly, mutual fund scheme or investment, one investment which is suitable for you might be allergic to me. It depends on your body profile. When it comes to medicine, it depends on your body profile. When it comes to mutual fund scheme, it depends on your financial profile. So you need a doctor. Doctor means your mutual fund distributor who can look at your, who can look at your risk profile, who can check the scheme's risk profile and give you the ideal scheme which is ideal, suitable to your goals, your risk profile. Right. So one is When you're sure that after 10 years, 15 years, you're going to get 20,000, 30,000, or maybe 50,000 monthly income, I'm sure that's a passive income. And when you have a great source of passive income, your financial freedom or independence is very near, right? The second thing, if you want to become independent, you also need to ensure that your home loan or any other debt doesn't hamper your wealth creation. Most of the time, at young age, when we buy home loan, when we buy a home with the home loan, we compromise on the saving part, and that compromise in the saving part will not affect you today, but it will affect you a lot in a long term in terms of less wealth creation, right? So how many of you have a home loan? Please type HL in the chat box. If you have some home loan, please type HL in the home loan. Home loan, right? So see, in a rising market, whether you take the help of mutual fund distributor or you invest on your own, you might get good return when the markets are good. So when markets are good, you'll never know whether you are better expert than your mutual fund distributor, or your mutual fund distributor was better expert. Actually, you still require a mutual fund distributor or financial advisor. Why? Because it's no market is never going to be in a single direction. It will not go up in a single direction. So I strongly suggest, if you're a headache and if you buy a paracetamol over the counter, that's fine. But when you have some serious disease, you need to consult your doctor. Similarly, if you want to invest just for 2-3 months, after 2-3 months you are going to require the money, then you can do the FD on your own. If you can buy some very safe product on your own. But if you are having some serious investment decisions, serious investment problems, serious investment goals, like your retirement, your child's education, your child's marriage, you should not take a chance by doing it yourself. Why not? I'm going to tell you in a while. Just give me 5 more minutes. But let's talk about this home loan. A lot of you are having a home loan and you might be paying a big EMI, and because of that your saving is compromised, right? But what if I tell you that I have some idea with the help of which you can recover all your EMIs back at the end of a home loan tenure. Say for example, if you are 25 years of tenure, you are repaying money to bank for next 25 years. Once the loan tenure is over, your loan is repaid. At the end of last EMI, whatever EMI you have paid in 25 years, entire amount you can get it back after 25 years. Are you interested? If I can give you some idea with the help of which you can recover all your EMIs, are you interested? Please tell me through chat box. Are you interested? Yes or no? Are you interested? Right. So let me give you an example. Let's say you took you're about to take the home loan of 50 lakhs rupees. Just a hypothetical example. And let's say home loan interest rate is 8.5%. And let's assume you want to go for a tenure of 25 years. Right? Now in this case, your EMI will be 40,261, which you're going to pay for 25 years. It means you're going to pay 1.2 crore rupees to bank to repay the home loan of 50 lakhs rupees. To repay the 50 lakhs rupees of home loan, you will be paying 1.2 crore to bank. So it's, you're happy because you have your own home, but you're also feeling some pain because you're going to pay a lot of interest. Now, what I'm just suggesting is, along with this 40,261 rupees, whatever your EMI amount is, just 20%, approximately 20% of your EMI, let's say 8,600 rupees, you do the SIP. Along with the 40,000 rupees EMI, you start one small SIP of 8,600 rupees. You'll be paying 25.8 lakhs rupees to mutual fund, 1.2 lakhs rupees to bank. So total you are paying 1.46 crore rupees in 25 years. After 25 years, your home loan is repaid. After 25 years, the SIP which you have done, 8,600 rupees, if it gives you 12% return, the future value of that SIP is going to be 1.46 crore. So you paid 1.46 crore rupees in next 25 years to bank and mutual fund through EMI and SIP, and SIP's future value will be 1.46 crore at the rate of assumed rate of 12%. Assume 12% is the assumed rate, not the guarantee rate. Guaranteed rate, and it is just for the explanation. In real life, if you look at the actual SIP returns of last 25 years, of the actual schemes, you will amazed. Let me give you an example. Say for example, ICICI Prudential Large and Mid Cap. It has almost completed 25 years. Had somebody did the SIP of 8,600 rupees before 25 years, current value is not 1.46 crore. Current value is 2.76 crore. right? Current value is 2.76 crore. So whenever you take some home loan along with your big EMI, start small SIP, right? And if you can't afford that SIP amount, then ask your bank to give you the loan for 30 years so that your EMI gets reduced. And when your EMI gets reduced, you can afford the SIP. Most of the Indians, the mistake which they commit is they take the loan of 10 years and 15 years because I want to repay the loan earliest. But if you want to repay the home loan at earliest, then you will have to pay the higher EMI. If you pay the higher EMI, you will not be able to invest through SIP. At early age, if you don't invest at the early age, you will lose the compounding opportunity. So better to go for the long tenure of home loan so that your EMI reduces. And when your EMI is reduced, use a small portion of your saving as an SIP. So always start a small SIP with the home loan. I've done it with my home loan in 2010. When I bought the home loan, I started a small SIP along with the big EMI. Right? And let me tell you, my home loan is already repaid. Not by additionally paying the money, only from that SIP money, my home loan is already paid. Right? Let me give you another example. Let's say you have already taken a loan before 2 years. You're not going to take a fresh loan, but you're already taking a loan. You already taken a loan in past. Your rate of interest was 9% and 20 years was the period. In this case, your EMI is 22,493, right? So you will be paying 53.98 lakhs to repay 25 lakhs rupees of loan, but you have already taken it before 2 years. You already paid not to, in this case, let's say 15 months. You took the loan before 15 months, means 15 EMIs are already paid. So your remaining loan tenure is 18 years and 9 months. Go to bank and ask your bank to increase your tenure from 20 years to 30 years. If your bank doesn't allow, then transfer your loan from one bank to another bank who is allowing 30 years of period. In that case, your EMI will reduce from 22,493 to a 19,810. There is going to be saving in EMI 2,683. Convert this saving in EMI into SIP and continue this SIP. Let's say you don't want to pay for 30 years. You don't want to stretch your home loan till 30 years. You want to complete it in 20 years. Still, on paper, you increase your tenure from 20 years to 30 years and see what happens after actual 20 years of period. After 20 years of period, you would have paid 53 lakhs rupees total to mutual fund and bank together, because in first case, your EMI was 22,493. In second case also, your monthly outgo is same, 22,493 only, which includes EMI and SIP both. So your outgo is same because you have increased the tenure. But after 20 years, your portfolio wealth is 29 lakhs. Your principal home loan outstanding is 15 lakhs. Withdraw the money, repay the home loan. Still, you will be left with 13.88 lakhs rupees. So if you increase the home loan tenure, reduce the EMI, and convert that reduction in EMI into SIP, you will be able to create the home loan from your wealth from your existing home loan as well. So there are two things. If these two things are in place, number one, passive income after retirement, right? Number one, passive income after retirement, then you will be financially free. That can be achieved with the help of SIP and SWP. And for that, I have given you the combination of Freedom SIP. And number two, you already, if you're having a big home loan, then you will not be able to feel financially free because you have that burden of paying EMI every month. And when you have a burden of paying EMI, you can't consider yourself financially free. But if you know that along with that EMI, you are having some strategy which will help you to recover all your EMIs back, then again, you will be able to enjoy your financial freedom. These are the two things which I suggest to everybody. One SIP for your retirement and one SIP along with your home loan. It will help you a lot in terms of achieving financial freedom, right? But when it comes to SIP, it is not that easier. Somebody said, I invest on my own. I go to Google, I ask them which are the best fund. I can get the list of from the Google and online platform, and I can invest on my own. Don't do that. Don't do that. Because selecting scheme, though I told you that even the worst performing scheme has given 10%, 12% return, but still I suggest you to take the help of expert, which is your financial advisor or mutual fund distributor. Why? Never invest based on the advice from the Google. When you go to Google, Google will give you the list. It will give you the information that which are the top five mutual fund schemes, which are the top five-star mutual fund schemes. But don't follow Google's advice. Why? Because whatever list of funds which you get from Google, let's say you went to Google and said top five funds. Google will give you the name of five different funds, that this is the number one, number two, number three, number four. And you will also see the return. Yeah, no, return is also very good. Don't consider Google's best five as a future's best five, because Google will give you the best funds list based on past performance, last 5 years return or last 1 year return. And return and performance and ranking keeps on changing every year. Let me give you an example. Large cap category, right? Large cap category. There are so many funds in large cap category in India. In 2019, the scheme which was at number one rank, right? In 2019, let's assume today is a 2019. Let's go back in the time. Let's travel back into the time 4 years back. If you would have Googled top large cap fund, you would have got some scheme name. I don't want to give you the name of a scheme because I'm not saying that this scheme was good or bad. I'm just telling you, number one ranking fund of 2019. In 2020, the rank changed to from 1 to 2. In 2021, the rank changed from 1 to 26. Number one performing fund went down to 26th rank. Means there were 25 different funds in 2021 which were giving you better return than this particular fund. So if you ask Google which is the best performing fund, it will give you this one. Means based on last 1 year return. But that ranking will change every year. Every year in last 20 years, I have seen every year asset class performance keeps on changing. Every year best performing fund, name of best performing fund keeps on changing. Every year best performing sector keeps on changing. Every year best performing mutual fund scheme keeps on changing. So if you go and ask Google about the best scheme, it will give you best based on the last few years return. And that ranking, which is number one today, might change tomorrow. Look at current ranking. Number one performing scheme of 2019 currently its rank is 30th. Not only lower cap category, look at mid cap category. Number one fund of mid cap category of 2019, its current rank is 24th. Small cap, number one small cap fund of 2019 in India, current rank is 9. Number one performing large and mid cap category fund, current rank is 26. Tax saving, number one fund of 2019, current ranking is 24. Flexi cap fund of 2019, number one, current ranking is 2027. But normally what we do is we ask Google and say, oh, these are the top five funds, let me invest into it. And when you invest, the performance keeps down, and you always wonder why it always happens with you only. When you invest, performance goes down, right? Because you are just using the wrong criteria to select the scheme. To select this scheme, you need to check almost 28 different parameters, and those 28 different parameters you will not be even able to understand without going through the proper training or without having that, certification examination. So when you invest through mutual fund distributors, they have this expertise. They know which fund is good for future. When they give you the scheme, it is based on future, not based on past. They look at the quality of the scheme. They look at this risk appetite of the scheme, right? So it is not always necessary that the number one, whatever scheme is given to you by your financial advisor will perform number one only, because their objective is to give you the consistent return, consistently better return, not number one. To chase number one is not possible at all. In last 20 years, see, I am MBA in finance. I have done CFP. I have trained 20,000 financial advisors in India. I got the 20 years of experience in equity, mutual funds and everything. But I can never predict which is going to be number one scheme of future. In future, which scheme is suitable to me based on my risk profile, right? That is, I can judge based on my experience. So your financial advisor will look at your financial profile, look at scheme's financial profile, and they'll try to give you some consistent good funds, which might not be at number one, but which will not even be 30th, right? So always follow the advice of expert when you invest. Never try to do it yourself, because do it yourself, you might save a couple of bucks, but don't do it. You will compromise on the quality. You need somebody who gives you not just the scheme suggestion, but who also can give you the advice about what to do, what not to do in various market cycles. When we talked about the example of aircraft, in aircraft, there is a turbulence Even if you are scared, you don't jump out of it. You know that you are going to reach your destination. Why? Because aircraft is strong enough to withhold the storm or any kind of a turbulence. The pilot is trusted one, experienced one. There is a co-pilot with the pilot which will help the pilot to navigate, which will help you get to reach to your destination safely. Similarly, when there is a turbulence in a market, mutual fund is the aircraft which is very good aircraft. It can withhold any situation. But not all mutual fund schemes. Even the worst performing mutual fund scheme in 10 years is giving you positive return, better return than FD. But there are schemes which are giving 20% and there are schemes which are giving 10% return. You can't find out futures number one, futures worst, but your objective should be consistent generating return. So mutual fund is the aircraft. Fund manager managing money in your scheme is a pilot. But you also need a co-pilot. Pilot alone cannot do the job. You also need the co-pilot to reach destination safely, and your co-pilot is your mutual fund distributor or your financial advisor. So if you have mutual fund aircraft, fund manager as a pilot, and mutual fund distributor, financial advisor as a co-pilot, then definitely you will navigate through this market up and downs, turbulence, and you will definitely achieve financial freedom and independence in your life. With that note, wish you all the very best. That's it from my side. Now, if you have any questions, I'm open for question and answer. If you don't have a question, a simple request. If you don't have a question before disconnecting, please share the feedback of today's session. Any feedback, positive, negative, whatever, that whatever you learned, whatever you liked, whatever you didn't like, please share your honest feedback in the chat box. I hope whatever time you have invested, you would have got a worth out of this investment of time. Thank you very much for joining. Thanks to entire team of Prudent Corporate. Thank you very much to entire team of all the Prudent partners, channel partners, and thank you very much to ICICI Prudential Asset Management Company for inviting me to address this esteemed set of crowd. So if you don't have any question, you can just share the feedback before leaving. If you have any question, you can put it in chat box. All right, that's it from my side. Over to you, Ramesh. If you would like to add anything, please go ahead. We can open the forum for the question answer.
Thank you, sir. Thank you for excellent session, and most of the people participated, and people are given feedback, excellent feedback also in chat box, and